This is the one that Tracy sent in for the week, titled "Global Oil Inventories Are Declining," and highlighting the huge decrease in in global oil inventories at the same time that there are the same production issues that she was talking about, that Tracy, that you were just talking about in the last segment. What are your thoughts on that?
So, here's again, once again, we have EIA revising everything, which is not surprising because they've done so since 2021. We've had huge revisions on demand, upward demand, and huge revisions on supply, downward supply. So, the EIA has missed their mark over and over again, literally consistently since 2021. And the problem here is that we're running into issues right now. And the only way that we can, the fastest fix, okay, so let me backtrack a little bit, sorry. But we have to look at what shale production is right now, lower 48. I think that we'll have, I think what conventional, I think we're going to be okay. I think that production is going to remain fine. That would be Alaska and the Gulf of Mexico. But if we look at shale, I think 2023, we hit the peak. And it had nothing to do with Biden. It had nothing to do with anybody who was president at the time.
Right.
Anybody could have been president. It had nothing to do with who was president at the time. We had a lot of smaller guys trying to produce as much as they can to be eaten up by the larger guys. We've seen these big M&A deals, right? Everybody wanted to look attractive to get swallowed up by the majors. And so, a lot of people, a lot of mid to smaller tier companies made a lot of money over the last 2 years being eaten up, and they produced a lot to make their company look more attractive. And so that's one of the reasons that we saw US production go up. But I think that we really have hit the peak in 2023, at least for the foreseeable future, unless something changes in the industry. I think we hit the peak in 2023. In fact, we just had EIA come back. They revised November and December down from 13.3 million barrels a day to 12.5 million barrels a day, which is a huge revision down, right? For November, December, and January. And it doesn't look like that is going to change anytime soon. So this is what I expect. I expect that we kind of have to hit our peak. We've hit probably max M&A. We'll probably see some more consolidation within the industry, absolutely. But most of the big deals are done now. And I think, and now a lot of that tier 1 acreage has been burned out. We burned through our duck wells, which are drilled but uncompleted wells. That inventory is kind of your backup inventory. Nobody's spending capital on building out new capacity. They're buying new capacity. And so I just don't foresee how shale production can grow much more at this juncture unless we have a complete change in what's going on in the industry. And so what that brings us to is, so how do we resolve this? Well, what could change everything right now is that OPEC, that has had cuts, in addition to voluntary cuts, most of that shouldered by Saudi Arabia, of attuned to about 1 million barrels a day. Now, if they change their mind and decide to get rid of the voluntary cuts, and they're going to go 1 million barrels per day after this June 1st meeting, 2024, that's the next meeting, then that would change the whole supply-demand balance. At this point, I don't see any reason why they would currently change their trajectory on how they are doing business right now, because, they have a limited spare capacity. They were going to build out spare capacity, but that was going to cost a lot of money. And Saudi Arabia has really aggressive plans right now to make that country a world-renowned tourist destination, as well as some other really big projects they have going on, like NEOM, and things of that nature, to kind of build out Saudi Arabia. To almost like a Dubai, right? I think they kind of want to be like a Dubai. And so, right now, they scaled back their plans on building out their capacity, because that was going to cost billions of dollars. And they're pouring that money in elsewhere, and they're making a lot of money with Brent at, $85, $90 a barrel. That's where they need it to be. So they know that if they decide to pour another 1 million barrels a day, get rid of the voluntary cuts on June 1st, that's going to obviously probably lower the price of oil by $5-7 at least right away. And they can't do that right now. They're perfectly happy with oil prices where they are. And I'm giving in, let's give and take, $5 for geopolitical issues. Let's factor that in. But still, again, $80 to $90 a barrel is the sweet spot for them. They like it. It's in their budget. They're making money. They're happy with it. And so I just don't see a reason for them to change their policy at this point. Perhaps later in the year, yeah, but June 1st, no.
That's, it's a great point. I think people often underestimate or don't realize that the depletion schedule for shale is much faster than it is for, like a traditional well.
Oh, absolutely.
And that's, that's a key thing. And, the US has been the leader in shale oil for a while, but those aren't long reserves. They deplete really, really quickly. The last question I've got for you is Deep Knowledge Investing has had huge positions in oil and energy since late 2021. So the fourth quarter of 21, they worked out great for us. We've made a lot of money in them. The current supply and demand imbalances that you were just highlighting, what do you think that means for our oil positions?
I think I'm still a huge fan of oil or energy in general. I don't think that demand is going away anytime soon, right? Especially if we look at emerging markets, particularly India and some African nations. And that's not going away anytime soon. It doesn't matter if Europe is in a self-devolving, spiraling deindustrialization pit. Oil demand's not going away anytime soon. Again, we've had OPEC and EIA and IEA all this past week come out, revised everything up, said we were wrong. Demand's been much stronger than we thought it was going to be for 2023, because it was their, kind of their Q4 results, right? And said, demand's much higher than we thought it was going to be. The imbalance is much higher than we thought it was going to be. And literally all three reports said that. And so I think energy, as you know, is a little bit squirrely, never goes in a straight line, has its ups and downs. But over the long term, I think it's going to outperform and do really well.
All right. Sounds great. Obviously, next time we have you on, we're going to be talking energy and uranium. And for all the different oil and energy organizations that missed their estimates, we'll just send them the same people here who are doing our employment numbers and see if they can get that sorted out. That's a regular theme here on the 5 Things, talking about how off the employment numbers are.
Yeah, last numbers are,
yeah, exactly. So Tracy, thank you so much. Always great talking with you. How can people find you for people who want to know more about energy from a real expert?
Absolutely. Our website is www.hilltowerresourceadvisors.com. I'm also on Twitter. That's my only social media account, which is @ShyGirl. It's because I used to work at CVOT, and I was from Chicago, so it was Chicago Girl, and so that's why it's Shy Girl, because everybody asked me. And that was 2009, so I couldn't change it. It's already, everybody knows me there. I also am doing a joint project with Damp Spring with Andy Constant, and that's www.dampspring.com, where I am doing a commodities collaboration with their existing portfolio.
All right, sounds great. We'll put links to your social media, to Hill Tower, in the description, so people can just click and find you there. Thanks so much for joining us, Tracy.
Thank you, guys.
Thanks,
All right.
Tracy.
Talk to you soon.
Great stuff
right.
there.
Yeah.
Any additional thoughts